How do you know when volatility is about ready to be picked up? Clearly, with the geopolitical situation, political situation, it just feels like volatility has a potential to pick up.
When volatility is really low, complacency is usually really high. The reality is when volatility is really, really low, it's only going to move in one direction. The one thing that you don't know is when and what's going to be the catalyst for that move. The pendulum has swung from paying a lot of attention to any data points as they relate to inflation, those data points kind of giving way to shifting our attention to employment. Volatility is probably going to be elevated from the lows and is going to remain so for the remainder of this year.
Welcome to Wealth Strategies Unleashed with Concenture Wealth Management. I'm Robert Gilliland, and
I'm Mike Alexander.
Hey, thank you all for joining us. There's been a lot of stuff going on in the markets, a lot of stuff going on in this world, which, by the way, I think that tends to happen all the time.
All the time.
Every time is
all
we've
the
never
time.
seen this before.
We've never seen it before, right?
And so, hey, Mike, one of the things that I thought that we would do, by the way, thanks for joining us again.
Always a pleasure.
Chief Investment Officer of Concenture Wealth. It's always our pleasure to have you here. I thought maybe it'd be a good idea for us to kind of talk through volatility. How do you know when volatility is about ready to be picked up? What are some of the warning signs? And then maybe we can get into how do we prepare? Because clearly with the geopolitical situation, the political situation, just kind of markets and cycles, it just feels like volatility has a potential to pick up. What say you?
So, well, thanks for asking. And as always, thanks for having me on. A couple of things. And I know this is perhaps goes without saying, but I think it's helpful just to remember that when volatility is really low, it's a sign that complacency is usually really high. And so there's a measurement out there, obviously, which is known as the VIX index, which is just the volatility index on the S&P 500. And for several years, it's actually been quite low, going as low as, say, 11 or 12.
Right.
Now, the number is not really as important. It's really just that number relative to where it can go. So for those that were obviously involved in markets at the beginning of August, we saw that number intraday on August the 4th hit 65. The reality is that when volatility is really, really low, it's only going to move in one direction. The one thing that you don't know is when and what's going to be the catalyst for that move. A lot of times it happens during the summer months when a lot of the volume is dissipated from the marketplace and you get some sort of news item or some sort of trigger or catalyst that actually drives that volatility higher. Volatility is probably going to be elevated from the lows and is going to remain so perhaps for the better part of the remainder of this year. And I think you just highlighted a couple of the reasons why that might be the case.
Yeah, you kind of go through and you look at, right, the VIX. The thing that I always heard is that it's not so much what the VIX actually is, it's when you get, like on August 4th, you get that big spike up, which kind of goes to show capitulation where people start throwing their hands up. August 4th was probably a period where some institutional investors kind of threw their hands up, though none of our clients seemed terribly concerned about it. But that big spike up generally means the next move when you have that massive spike is back down. I don't remember, it's not really a fair question. Do you remember back in 08, 09, how high did it get?
We saw some, I'm going to say that it was in the 60 range as well then. Now, we remained elevated for quite some time. Even during the COVID period, we remained north of 30 on the VIX index for quite some time, and it actually stayed there for a little while. And I think what people would say even back in those days is they said, once that volatility finally begins to calm down, it tells you that also that investors have become a little bit more calm and a little more understanding of the situation. So the example in the beginning of August was that we had this yen carry trade that began to unwind, right, where levered players had to unwind positions because they were exposed. Without going, getting really into the weeds on that, I think the reality is that it was an event. And once that event was in the rearview mirror, things have returned to what I would say a much calmer period of time. Still elevated, and I think the reason for that elevation is one, certainly election and politics. Now that's likely to be a short-term phenomenon because markets typically will adapt to whoever's in power. They just need to know the rules that they're going to play by going forward. I think that the second reason is that investors have been somewhat concerned over a growth scare, if you will, in the marketplace, and I think a lot of that came from us really going through an environment where the pendulum has swung from paying a lot of attention to any data points as they relate to inflation, and that those data points kind of giving way to shifting our attention to employment. And so you started hearing this, recession and those types of,
But that seems to always kind of comes through and happen, right? It seems like in the absence of earnings news, we pay attention to economic data. In the middle of earnings season, they're still giving weekly employment numbers, and the trends have basically been the same, and that's not moving markets. It's the actual earnings of companies.
That's absolutely
and so,
been the case.
So when you don't have earnings, then all of a sudden everyone's paying attention to employment, CPI, PPI, those kind of things. And when you have earnings, yes, they're important and people pay attention to them, but that doesn't seem to move markets near the same way.
Well, there's an old, you bring up a good point. There's an old adage that says that, markets will always climb a wall of worry. You've heard that before. We've talked about it. Typically, stock prices will move with earnings. So if earnings are growing, they're typically going to do well. But in an environment where, let's just say, valuations might be a little bit stretched, investors start to pay a lot more attention to, earnings for sure. Like, that's great that you hit your earnings, but they also start to listen to things like, what's your guidance? How are your revenues? What about sales? Are you hitting your earnings numbers because your workers are just that much more productive, or are you hitting your numbers because you're actually selling more? And I think, this last time through this Q2 earnings, which really began to roll out in July, I think you saw a lot of attention being paid to whether or not companies were actually selling more in terms of goods. And so when you saw a number that was somewhat disappointing, even if they hit their earnings numbers, you would see elevated levels of volatility associated with that. Companies that missed sometimes or guided, let's say, didn't have the rosiest of guidance, right, they probably were down more on that news than companies that actually hit their earnings and hit on everything were up during those periods of time.
Yeah, when you're going through and you're talking about volatility, one of the things that I pay a lot of attention to, right, is first of all, to back up a little bit, I think it's important to understand when we're talking about volatility, I think that the average investor out there thinks of volatility as only on the downside, right? And I think what you're talking about and paying attention to the VIX and some of these other things, right, to determine where we are is when is that momentum going to change? So if we stay with the VIX as an indicator of what's happening, if the VIX is at lows and it stays down at lows, the next place to go is
higher,
up, which means that means downside risk is increasing, right? The VIX is at 62. Odds are the next several moves, maybe not the next day, maybe not the next week, but at some point in the near future, that next move is going to be down. That creates opportunities, right? And I think that the thing that I notice is when you're looking at the way that investors should be evaluating their portfolios and getting prepared, because I think we both agree that probably we're in a period of increased volatility, meaning ups and downs inside of this market. And I think that the thing that investors need to be looking at is are they prepared to weather those storms? Financial success, I'm come firm belief that financial success is continuing to own quality investments that can get through there, but you may have to make changes as long as you have enough cash flow to maintain your standard of living.
You're 100% right. I think when we talk about, an index like the VIX index and we talk about volatility, that may not matter at all to a client who is investing conservatively. And so the thought process here is that every client's portfolio has its own volatility. And you can construct a portfolio that's going to have more volatility than the market. You can also construct one that's going to have less volatility than the market. And so it's really about risk tolerance, not as much about volatility. Volatility can be your friend, especially when you're actively investing. It becomes less your friend when let's say you're retired and you're not committing new assets and you're living, your money is going to work for you every day and it's designed to generate an income stream for you. Then all of a sudden volatility is not your friend because it's much more difficult to buy low and sell high and when you're not committing new capital to the process.
It's interesting. I pay attention that when in going through and talking to clients, when clients are talking about we need to have some, I'm going to leave companies nameless, XYZ company, because XYZ company has been going up and up and up. It's the only thing you read about in the headlines. That tells me that we're near a top. On the other side, when you have a significant downside inside of the markets, when clients call and they say, "Get me out, I don't care what cost," that's called capitulation. That generally is the time that the markets are going to turn. And that's the way you get through these periods of volatility is making sure you have enough cash or liquidity on the sidelines to weather either one of those. I do think that it's important when you're talking about individual securities and looking at it in the form of your overall allocation. Just because you own XYZ company, if something has fundamentally changed with the company, you probably want to make a change in your investment, right? And so that volatility, if nothing's fundamentally changed, that volatility could be your friend if you have enough powder dry to go ahead and continue to add.
Yeah, it can put you in a situation where you become an opportunistic buyer. I think the main thing when it comes to constructing portfolios that can weather the storms of volatility is not being put in a position where you become a forced seller of assets.
Right.
Because just remember, whenever there's someone that's having to sell, there's someone on the other end of the line that's actually got the basket open and is actually gathering those assets. So that's all about portfolio construction. It's about understanding risk tolerance, and it's about maintaining some level of diversification across various asset classes.
The other thing I think is that when you're in periods of volatility, thinking of downside risk primarily when I say that, I think that if you have a strategy to take advantage of that, in other words, dollar cost average, you take a lot of that out because the reality is that if whatever that investment is a good deal at 100, at 80 it should be a really good deal as long as something fundamentally hasn't changed inside of that if the strategy stays.
Yeah. The old, if you liked it 100, you're going to love it at 80 and you'll like it even more at 60. But there is a point
that means
where
something fundamentally has changed, right?
Maybe something fundamentally has changed, that's for sure.
But everyone likes to buy things on sale.
Absolutely.
And so I think that. Anything else with regard to understanding volatility and how to be prepared that you can kind of think of?
Yeah, so it's a great question, Robert. And I think a lot of people, a lot of people will come to us and say, "All right, look, we're getting into the latter part of 2024. What could be some triggers of volatility?" And without putting on political or geopolitical hats, I think what we can understand is that yes, we have an election coming up. Both campaigns should have policies that they're going to lay out. markets will adjust to whatever the policy is. But for now, they're not known, and we don't know who the winner is going to be. It's not, it's not crystal clear, at least at this point. The second thing is that there's geopolitical risk out there. We've had saber rattling around the world, whether it's been in Asia, the Middle East, or in Eastern Europe. And some of these conflicts have been going on for quite some time. And there's always a risk that one of those escalates or spins out of control and causes what we would call a volatility event. Can you really plan for them? You can't plan for the exact outcome, but you can say, hey, there's always something like that going on somewhere in the world, it seems like.
Always, yeah.
Right? It's always something. And so those are the types of things that you can kind of plan for. And the second thing, and I think we've mentioned this in other discussions, and that is that, at least as of now, markets have done really, really well for the last 2 years. Coming off of a difficult 2022, 2023 has been great, 2024 has been very good as well. And we know that trees don't always grow to the sky, and that at some point, there's a reversion to the mean. So maybe the best way to think about it is that there are years when markets give you less than you deserve.
Right.
But there are also years when markets give you more than you deserve or more than they should have. And over a long period of time, they tend to level out. I just think it pays to recognize that that's the environment we're in. By the way, we'll be heading into 2025, which will bring with it, a new president. And when that occurs, we know historically the first and second years sometimes can be a little bit tough for an incoming administration. So those are just types of things. They don't necessarily trigger long bouts with volatility, but they certainly can trigger volatility events, if you will. It's good to be prepared.
I think that's a really good point. You go through and you think about, I think it's really important to understand, and I really appreciate your comments kind of about the VIX. Understand where you are to get an idea of where you are, where you're going to go, right? So when you're going through and you're looking at the VIX, if the VIX is historically low, and it's been historically low for a long period of time, hey, odds are you're getting ready to have some volatility. Mm-hmm. On the opposite side of that, if the VIX, the volatility index, is very high and has been high for a little bit, or it's spiked, you're probably getting ready to have the markets, they probably have settled and getting ready to kind of go. So that's kind of an indication. The other thing that I think is really important is to understand where you are in the economic cycle. It's inevitable. It's like a clock. We have been in it. You go through expansion, you go through troughs, you go through expansion, you go through troughs, right? That's what ends up happening. It has been a long time since we've had a real recession, though you and I both agree that there have been industries that have been kind of going on these rolling, but
That's
for
true.
an overall full-blown recession, there's a good chance that that's going to happen, right? At some point in the near future, we're going to see a recession. Making sure your portfolio's prepared for that volatility that's going to be inside there. If you are near or at retirement, that means making sure you have enough cash to meet your standard of living. Making sure the quality of the investments, you're not taking too much risk. And I think understanding where you are so that you can make good decisions about the future becomes vitally important.
I could not have said it better. You're 100% correct.
Well, that's good because I thought I said it really good. So
You did.
So with that, I'd like to say thank you for joining us this week on Wealth Strategies Unleashed with Concenture Wealth Management, and we'll see you next week.
See you next time.
The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategy that may be discussed does not guarantee against investable losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believable to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation.
This work is powered by Concenture Wealth Management, registered representative of Sanctuary Securities, Inc., an investment advisor of Sanctuary Advisors, LLC. Securities offered through Sanctuary Securities, Inc., member FINRA, SIPC. Advisor services offered through Sanctuary Advisors, LLC, an SEC-registered investment advisor. Concenture Wealth Management is a DBA of Sanctuary Securities, Inc. and Sanctuary Advisors, LLC.